Welcome to Industry Insights with Route Consultant, your front row seat to the fast-moving world of logistics and beyond. Each week, we bring you game-changing insights, real-world strategies, and fresh perspectives to fuel smarter investments and build stronger businesses. Join us as we sit down with expert guests to explore emerging trends and pressing topics across a wide range of industries. This is Industry Insights. Right. We are going to go ahead and get started. I see everybody filtering in. So welcome everyone to Industry Insights Live. For those of you who are here for the first time, my name is Josh Gregory. I am the Vice President of Operations here at Route Consultant. If you're not familiar with us, our team ran hundreds of routes across the country in both P&D and Linehaul. And today we're here for a few main things, helping new buyers that are looking to get into the space for the first time, and to help current contractors that are already in the space to help find efficiencies and additional profitability in their business. Now, before I go too far, I do have a quick disclaimer that I have to read, as I do every time I do one of these live. So Route Consultant is not endorsed by and is not recommended by Federal Express Corporation, FedEx Ground, or Amazon. Route Consultant is not sponsored by, is not approved by, is not associated with, and has no connection whatsoever with Federal Express Corporation, FedEx Ground, or Amazon. Now, we are going to be talking through a bunch of things today around FedEx in particular. If you haven't seen why you clicked to sign up for this webinar today, we're going to be going through a report that we put out and that is free to download on our website. We can make sure that we get it to you if you haven't seen it already after this. As we're talking today, if you have questions about anything we talk about or about the space in general, if we're talking about one thing and you think of a question about something else, you're free to ask it at any point. My only request of you all is that you put it in the Q&A button, which for some of you may be hard to find. It's actually kind of annoying. Zoom changed some features where you might have to click that little more button with the three dots at the bottom and go to the Q&A. And you can type in your question there and I'll see it. I'll answer it live. Ask Leah, ask me. If you can't find the Q&A and you want to put your questions into the little chat button, I'll still accept it. But ideally put it in that Q&A if you want to make sure that I answer your question today. One quick event that I want to highlight before we get started is if you're still a new investor looking to get into the space for the first time, next Friday on July 17th, we have a new investor workshop in our office here in Nashville. Those are designed to teach you everything we can in one day about the space in general and trying to really give you a crash course on what this industry looks like, both FedEx, Amazon, Bread. We try to give you a full breadth of what to expect there so that you can kind of go in eyes wide open. And so if you really still are on that starting line, it's a course that's designed to accelerate and get you running as soon as possible. It is free to attend. It's just, you got to be here in Nashville. So you can still register for that event. It's on our website, on our event page. And so if you're interested, that is next Friday in our offices here in Nashville. So on to the meat of today. So I am not talking alone. I will be joined today by Leah Nelson. If you haven't met or heard from Leah, she's our Director of Research and Reporting at Route Consultant, and she's led our analyst department here for years. So she's seen hundreds, if not thousands, of these deals. And what she's going to go through today is a report that she put out and put together around some benchmarks on some numbers on what we're seeing in 2026 so far around valuations and data and everything that builds into those valuations in the FedEx space in particular, and we'll touch a little bit on others as well. So with that said, I will kick it over to Leah if you want to introduce yourself and go ahead and get started.
Yes, absolutely. Hello, happy to be back. As always, like Josh mentioned, I'm the reporting and research director, and you're right, I've seen, hundreds of thousands of deals probably in my years here. So, and very familiar with the FedEx market and some of the silo markets as well. So we'll just jump right in and really to get started, I'm going to throw out some quick data points so we know exactly where the market is sitting right now, whether you're looking to buy a business, you can see what average businesses are priced at, or if you want to sell yours, you can kind of figure out what it might sell for. So just for some rapid fire pricing metrics, the average P&D multiple right now is about a 3.98. The average Linehaul multiple is about a 3.8. The average P&D percentage of revenue that's being sold for is about 80%. Linehaul is 77%. Average asking price for a P&D business is 1.7 million. Linehaul is 1.6 million. And to round it out, the average P&D margin is around 20% and Linehaul is about 21%. So they're actually really sitting pretty comparable right now on nearly all of those metrics. And of course, I always like to say, those are just averages. That's one data point. There are about a million factors that can drive a business's value up or down. We've got tons of content on that. That's not really what we're covering today, but those are the averages that we're seeing the market right now. So I know today we're focusing on, kind of 2026 trends, but I did think it would be interesting to take a look back, really all the way back to 2021 and see how some of those trends have changed in the last 5 years. So starting with P&D, we have seen really, I would say, radical growth in the businesses being sold in this sector. So P&D operations on the market have doubled in price in the last 5 years. So in 2021, the average P&D business was valued around $860,000. And now, like I said, the average sits around 1.7 million. So that's a fairly significant difference there. Kind of speaking to that, in the last 5 years, we've seen FedEx really change their mind on how large they want their operations to be. For years, we were required to split businesses into smaller pieces to sell them because FedEx favored smaller contractors. Like I said, for most of the years that I worked here, I would say that was the case. But that is no longer the case. And we're seeing these really kind of giant operations up for sale now. It is worth noting too that P&D operations not only grew significantly from 2021 to 2026, so that 5 years, but we've even seen growth from 2025 to 2026. So even in the last year, P&D, last year, P&D operations were listed at around 1.2 million. And again, to reiterate, we're about 1.7 million now. So we've even seen quite a bit of growth in the last, 12 to 18 months. This increase in P&D pricing isn't, due to just sellers increasing their prices. They're not just like, hey, I've got the same size business, I want to jack up that price. In fact, listing multiples have really remained steady around 4 times for the last 3 years. And even farther back than that, they weren't, terribly different than that. It is due to larger operations overall. So in 2021, the average revenue for a P&D operation that was, being sold was around 1.1 million. And then this increased to about 1.7 million in 2025, and revenue now in 2026 is averaging about 2.1 million. So the businesses that are on the market are growing as well. We've seen a similar trend in the route count for businesses. So again, also just speaking to the physical size of them, an average of 10 routes in 2021, 14 in 2025, and we're up to 17 routes now in 2026. Now notice, the revenue and price has essentially doubled in the last 5 years, almost an exact double. And while the route counts have increased, certainly, they haven't quite doubled. So we went from 10 routes to 17 routes. That's because we're seeing really higher revenue per route, which indicates P&D operations are probably more efficient now than they were in the past. They're earning more revenue per each individual route. And the higher the revenue per route, the more efficient a business is. It's a benchmark that we really use to see if a business is performing well. One metric, kind of speaking to that, the revenue per route increased from $119,000 in 2025 to $125,000 in 2026. So, more efficient businesses, perhaps FedEx is paying more to compensate for some of those, kind of rising costs that we see sometimes. Also, kind of hopping into, so we're kind of been talking about list prices. So this is what businesses have been listed for. Hopping to closing prices. So P&D operations are really closing at higher prices, than ever before from both a dollar standpoint and as a percentage of their asking prices. So sellers are currently averaging 94% of their asking price, meaning that if a business is listed for $1 million by the seller, on average, that seller is taking home $940,000 or 94% of what they listed it for. This indicates really right now a seller-friendly market. There are quite a few buyers vying for P&D deals, so they're negotiating less and offering more. To kind of, basically what this means, the negotiation gap has, largely disappeared. There's not a lot of negotiations going on. In 2025, sellers were kind of routinely building in about a 20% discount between the ask and the close price. But again, now we're seeing about a 6%, delta between those two numbers. What this means practically is if you were pricing your business too conservatively as a seller because you're expecting buyers to talk you down, you are leaving money on the table. Buyers are really showing up ready to transact, close to full value. So accurate, confident pricing upfront matters now more than ever. Don't sell yourself short. because again, it's a kind of a seller-friendly market right now. Um, One thing that has made this possible, kind of these higher numbers, just from the higher closing prices, just at the larger businesses overall, is the availability of financing. So in 2021, and even moving through 2023, 24, a couple of years after that, P&D deals were dominated by cash buyers. We were seeing 50, 60, 70% of deals as cash deals. In 2026, only 14% of deals have been closed with cash so far. The other 86% of deals were either closed with conventional lending or SBA lenders. This signals an increased willingness to finance P&D businesses as banks get more comfortable with them over the years. This also really ties into that trend of having larger deals. Now that FedEx has that kind of preference for larger businesses, they are no longer requiring contractors to carve their businesses into pieces. Banks are more likely to finance them. So whole businesses always, always, always have a higher chance of securing financing as opposed to carve out deals, which is what we were facing for years. So kind of round out that section of P&D. Now let's take a look at kind of the similar line haul trends over the last several years, which vary pretty significantly from P&D. While P&D list prices have kind of doubled over that 5-year stretch, line haul has gone really in the opposite direction. So digging into those line haul numbers, the story again, it's kind of a mirror image of P&D. Back in 2021, the average line haul listing was going for about 2.8 million, and today it's down to about 1.4 million. So it's about half of what it was as opposed to doubling like P&D. It's a pretty big contraction, and it tells us that line haul isn't quite commanding the premium that it used to. Kind of where it gets interesting too is what happened, this year. So deals are closing at around 71% of their list prices, down from 89% in 2025. That is a bit of a wide negotiation gap. And it tells us buyers are pushing back a little bit harder than they were even a year ago. So even though sellers are still listing with confidence, they do have to give a little bit more ground to get a deal done in the line haul sector, whereas they aren't necessarily seeing that in P&D. So, kind of a little bit of a caveat here, speaking to some of these closings. We didn't have as many line haul closings in the Q1 of 2026 as we did of P&D closings. So our data is just a little bit thinner there than P&D. So really excited to see kind of what the rest of 2026, plays out for us as we close more and more line haul deals towards the end of the year. But speaking to that, these are kind of more directional numbers than like hard gospel numbers. But the message is consistent either way. Line haul buyers are being a little bit more disciplined, and they're not willing to pay quite up to the same price as P&D buyers right now. Financing in the line haul sector kind of tells that same tale of a market, in transition phase. So back in 2021, cash was also king in line haul. We were seeing, between 70 and 85% of deals close with cash. Again, similar to P&D, this has changed a lot. In Q1 of 2026, financing in line haul was split evenly about 3 ways. So about a third SBA, third cash, and third conventional. So we're seeing a lot more financing deals in this sector as well. So lenders are clearly getting more comfortable with underwriting line haul, but they're doing it, with some scrutiny, especially around run stability and where, the contract is consistent, and has a history of like unassigned runs that are again, we like to see that consistency in line haul with financing. What's having kind of, portfolios that are primarily unassigned or wild or not consistent can be a way to get denied by the SBA. Operationally, though, line haul has stayed pretty steady. Right now, we are looking at an average about 5 runs per contract, 6 trucks, and 9 employees. So over the last few years, those few numbers haven't really moved. From 2021, they have. I actually don't have that data in front of me right now. But the last 2 or 3 years, they've remained fairly consistent. Margins are sitting at around 21% right now, which is a little bit higher than it's been the last few years. So we're seeing those go up. There is one line item in line haul that is creeping up and kind of worth flagging or noting, and that's going to be repair and maintenance. So the average repair and maintenance cost for line haul was just around 10% of revenue in 2025. And with line haul businesses listing now that we're looking at, it's about 12.5%. So we've seen over a 2% increase in those repair and maintenance costs. So that's a pretty meaningful jump. It's a function kind of aging fleets and operational strain that comes with running a little bit lean. If you're a line haul contractor, repair and maintenance is quickly becoming kind of the biggest lever on your margin. So it's worth getting ahead of that before you list. If you're choosing to list your business, go ahead and make sure your repair and maintenance is really in line. That's going to be something that buyers are really looking at. And even if you're not selling right now and you're just watching this for some benchmarking, make sure you're keeping that steady as well. So let's kind of shift gears for a minute and zoom out and talk about some efficiency benchmarks, particularly for P&D. So if you want to earn, a 20% margin, which is considered strong, average to strong, the ratios that matter the most are your trucks per route and employees per route. So on the truck side, you want to be running close to a 1.2 times ratio, meaning you have 1.2 trucks in your business for every one route that you have. This extra buffer gives you the capacity for repairs and volume surges without, really grinding your operation to a halt. You've got some spares in there to help you out. And then on staffing, we see a 1.3 times ratio of employees per route. And that gives you a coverage for absences, call outs, and just general coverage needs. These two numbers are a really strong indicator of your operational health. So now we're going to kind of dive a little bit more into the average expenses for both P&D and Linehaul. We touched on Linehaul a second ago, but we'll get into it a little bit more. Both of these, P&D and Linehaul, do have kind of similar margins right now. So we're seeing around 18 to 20%, like I mentioned earlier, for both P&D and Linehaul. So they're sitting pretty similar from like a bottom line perspective, but the way that we get to that bottom line looks completely different for both of these types of operations. So driver wages are sitting at about 43% of revenue for P&D versus 36% in Linehaul. Fuel is the opposite of that. So it's about 10% of revenue in P&D and up to 20% in Linehaul. So it's about double in Linehaul as P&D, which, makes sense. You're driving across the country. Repairs and maintenance runs about 8.5% in P&D, again, seeing that 12.5% in Linehaul, which again, we kind of talked about, it's climbing a little bit. So we're hoping it maintains around that 12.5% or lower, goes down. Insurance and payroll taxes are both a little bit higher in P&D, sitting at around 4% versus 3.5% in Linehaul, but comparable either way. So if you are, evaluating a deal, or again, if you're a contractor and you're looking at your own metrics, you really should be, looking at all of these different expense percentages and comparing yours to them. And if you're radically above any of these averages, you may want to take, some time to figure out why and to really kind of repair that problem. Ooh, sorry. So one other thing that I want to mention kind of with scaling in P&D. So as these operations get bigger, we're seeing management efficiency improve and payroll get more optimized, which is great. But that scale also brings more complexity into your fleet, and repair and maintenance starts to creep up right alongside of it. So, your growth isn't free. The larger you get, again, you kind of get some efficiencies with management. You can have more management on, you can handle a couple of more drivers, but it just really kind of trades one set of cost pressures for another. And the operators who do well are the ones who are actively managing that trade-off rather than just assuming bigger automatically means better margins. So again, you really get some great economies of scale with your payroll and management, all those things, but you can, the larger businesses get, we do see those repair and maintenance costs go up. You've got more fleet, more trucks in your fleet, you've got more spare vehicles, and just more things could go wrong the larger you are. So you should make sure you're managing, don't ignore one or the other, really actively manage both of those. So now we're going to touch on some regional trends that we've seen. It's kind of just a small little blurb here. But the South continues to really be the most active market. They have the most listings. So if you're looking to buy a business in any of the southern states, you will have plenty of options down there. Mid-America is where we're seeing the biggest operations and the highest asking prices. So with, route counts are regularly exceeding, 20 or more routes. So if you have a lot of money and you want a large business, maybe you want to place your focus in that kind of Mid-America region. The East is really standing out for revenue per route. Their routes are hitting at around $140,000 per route, which is higher than the national average. So if, efficiency is your game, take a look at the East. Costs are also a little bit higher in the East. So, that needs to be a factor there as well. And then the Central region, we're seeing, somewhat compressed margins in the Central. They do have slightly higher payroll costs in that region. So that is something to consider when you're looking out there. So, where does that leave us kind of heading into the rest of 2026? So if you're selling a P&D business or thinking about doing that sometime soon, the playbook is pretty clear. So scale matters. If you can, you've got a business that's pretty large, 15 routes or more, you're going to attract probably a wider buyer pool, including both SBA and conventional, lending buyers. And you should be pricing that business really strategically. So again, deals are closing really, really close to their asking price. There's not a whole lot being left on the table, so don't leave it on the table yourself. Don't sell yourself short there. Be reasonable, always be reasonable with your valuations, but don't sell yourself too short. And if you're on the line haul side, the story's a little bit different. So the market really rewards stability. So having clean financials, a really consistent run history, and a proactive maintenance plan is what's gonna, get you financed and get you a fair valuation and really bring in those buyers because those are the things that they're going to be looking at right now. So for, kind of the buyers and investors, everyone who's looking at these businesses, again, kind of a couple more just checklist items. You want to, maintain your 1.2 truck to route ratio and 1.3 times employee to route ratio. Keep a close time, on your overtime and your wages. Budget for rising maintenance costs, especially if you're in line haul. And again, cannot reiterate this enough as a financial girl here. Keep your financial records clean because that's what maximizes your financing options and again really opens that buyer pool up instead of just being able to focus on cash buyers. So that's really kind of what we're looking at right now for the market. I'll close there.
Perfect. Thanks, Leah. And I've got a couple of questions for you. And I know that there's going to be a couple that'll come into the Q&A that we've seen already. I've tried to answer some of them, but there's going to be more that come in. But before we go to questions, we talked a lot about FedEx. Is there anything that you wanted to call out that you maybe saw in the bread space? I know we are involved in that space now, so we have some data there too, if you wanted to share any of that.
Yeah, absolutely. So yeah, we certainly dabble in bread. We do focus on FedEx a little bit more, but kind of a brief update on bread. So we've got some pretty interesting stuff here. So we've kind of got two types of routes. We've got corporate routes and private routes. And so I'll touch a little bit on both of those. So starting with the corporate routes, which are routes operated and sold by the bakery themselves. So the bakery basically employs a driver and they're doing it on behalf of, not on behalf of the bakery, but the bakery is doing these routes. So the asking prices for the corporate run routes increased a little bit from 2025 to 2026, about 10K. So right now, the average price of a corporate route is sitting at around $127,000. Revenue has remained really consistent at around $775,000. And the asking price as a percentage of revenue is around 15 to 16%. And multiples for the last year or two have been around 8 times. So in 2026 and 2025, that's been really, really consistent. Corporate routes are generally pretty predictable as far as pricing goes. That's really determined by the bakeries themselves, which they have their metrics, and so most of them turn out the same. There's not a ton of room to negotiate on those. The prices just are what they are. And then we've got private routes, which these are owned and sold by individual operators who are basically contracted with the bakery. So it's a little bit more FedEx adjacent. So prices for these, we saw prices around $188,000 last year, up to $312 this year. But revenue has also climbed from $588,000 to $912,000. So we're just seeing kind of larger bread routes this year than we did last year. The multiple has moved up a little bit from around, I say multiple ratio has moved up a little bit from around 17 times to 19 times, which is not terribly, it's a huge difference there. And then the asking percentage of revenue is around 32 to 36%. Unlike corporate routes, private listings still leave you a little bit of room to negotiate. But generally, all of them kind of close to their original asking prices regardless. Private routes, I would say generally have more kind of functioning systems and schedules in place because an individual operator is already running them. So they sell for a little bit of higher prices than corporate routes. If you buy from a really competent individual route owner, you're paying, for the convenience of hopping into a really well-run business. With corporate routes, you do have to put in a little bit of, I would say, legwork to get the business up and running, how it works for you. So they come at a little bit of a discount, and that's why we see kind of those pricing differences there.
Perfect. And I'll throw into just, if people have questions on this data, again, this is a report that we've put out. You can get all of this information afterwards if you don't have it already. So it's, if you have more questions on specifics on the data, you can ask it. Leah might know it, just depends on how specific, how in depth you're going in the data. She might have to give you a follow-up response. So happy to take any of those as they come in. a question that I'm seeing asked a couple of different ways that I've seen come in as we've been talking, Leah. I'll take first stab at it, but one of the main things people are asking about is the 2.0 transfer in the FedEx space, how that's affecting valuations. And one thing first, I'd like to address Ricardo's questions. He was asking if how 2.0 is affecting the transition of businesses. So just for those who don't know, aren't aware with the transition happening in the FedEx space right now. There's a FedEx 2.0 is the big move that FedEx is doing where they're trying to consolidate all of their different networks between FedEx Express, FedEx Ground, which is the traditional contractor base of the FedEx network. And then there are some others, like FedEx Freight there's some consolidation happening there. But the 2.0 conversation when we're referring to it in this space is that as people move to this new express model, there's some changes that happen to the contract. Sometimes the territory changes as well. And what happens is essentially FedEx will give you several month heads up that your 2.0 conversion is coming. In that period of time, they're often not allowing transfers on businesses. Or what may happen is FedEx may allow the transfer, but a bank may say, hey, we have to wait until we see afterwards. So there's a combination of factors affecting transferability of these businesses in the middle of the 2.0 transition. This is a good chunk, like 75 to 80% of the network should be done by this year, but we're actively in flux in a few different areas where, in the next few weeks, there's a big wave of transitions happening. There's another as we get closer to peak season. And so there is some FedEx saying you have to wait till this is over, and there's some of banks saying you have to wait till this is over, where you may be in the middle of a deal and then you may have to wait a few months to see how things kind of turn out. Now, a second question around this is, how is this affecting pricing? How is this affecting valuations? It's one of those where for the most part, I've seen a lot of these deals where either the territory is similar in size or in many cases larger or doing more revenue than it was previously after the transition. So it could be a positive from a revenue standpoint. I found that buyers aren't super likely to say that, hey, if the business is worth X today, I'll pay a premium on what it could be. It's one of those things where if you're locking in the deal as a buyer before the transition, there's a little bit of a dice roll, but there's pretty good odds from what I've seen that you're going to come out on top, that you're going to have a better territory for the most part than what you have now. It's really FedEx's goal to create more consolidated, denser territories that are more able to handle the growth that's coming. For those of you who are in the network right now and are seeing some of the volume and large packages that are hitting the network as we come out of the Prime days and as we I was talking to somebody who said it felt like it's been peak for weeks or months, and peak is coming. So what FedEx is trying to do is to create territories that can handle these spikes in volume, handle this large package volume as it comes into the network. And I wouldn't say that it's necessarily a change in valuation, but what's really important if you're a seller or if you're working with a company like Route Consultant is helping the buyer, helping the bank understand what the transition looks like, and giving as much clarity as possible on what it'll look like afterwards, and keeping everybody on the same page. Because it's one of those situations, anytime there's a delay for any reason, deals fall apart. So a lot of what I'm seeing right now in 2.0 is making sure that as much data and projection is consolidated and quantified. It's what Leah and her team are doing all the time, of helping buyers and banks and sellers understand what afterwards could look like as the new contracts come out, as the new models come out. What I would say is that we're in this period of flux. If you can get in beforehand, for the most part, I'm typically seeing businesses that are worth more afterwards with the new contracts that are coming in. But it is one of those situations where there's a little bit of flux, a little bit of delay right now in certain pockets of the country. There's also plenty of areas that have already gone through 2.0. This isn't if you're buying right now, no matter what, you're going to run into this, but it is something to be aware of. Certain pockets of the country have already finished. Certain pockets are just about to finish. And then there's going to be, the way it always is with big transitions in the FedEx network, there's going to be small pockets of the country that take years, unfortunately. But the vast majority of businesses, it's FedEx's goal to be done this year, and by early to middle next year, that this is an over and done with problem, and now we're moving on to efficiencies and what the businesses look like coming out of 2.0. So hopefully that answers that around 2.0. If you have more questions on that, feel free to send them in. I did see it, the chat come in. Leah, can you repeat some of the percentages around expenses for P&D that you were talking about?
Certainly, yes. Let me get back to it. So for P&D, so we're seeing wages at around 43% of revenue. For fuel, it's about 10%. Of course, we know that can vary based on the mileage that you're doing, but 10% is going to be our average there. And then repair and maintenance is around 8.5% for P&D. And then payroll taxes and insurance are typically about the same at 4%.
In the chat, if you have more questions about that, feel free to ask it. Okay, question here from Tony. I saw come in around, you're talking about how dedicateds can provide reliable revenue, and that it can often, dedicated solos can often be at a premium. Does the same apply if it's low weekly mileage? Are there mileage bands that we consider when we're talking about the valuation and value really of some of these runs?
Yeah, so there are, I don't know the mileage bands off the top of my head, but there are certainly mileage bands that we kind of consider it a less profitable run, kind of a mid-road run, or a high value run. Whether it's a team or solo, those are going to vary a little bit. And but we do take that, I would say, into somewhat of consideration. If it's a lot of low mileage, solo runs that you're doing, that's going to be reflected in your profit margin. You're probably going to have a lower net income. Whether, if you have a bunch of, high mileage solo runs, that's going to also be reflected in your margin. You're going to have a higher margin, and that's the case. Same thing too, if you have unassigned runs in there, if they're, high mileage and consistent enough, and by consistent enough, I mean really consistent, they can be very valuable as well. It's just a little bit of a harder sell, I would say, if you're doing financing, because they are not as contracted. Even if they are really consistent, if you're running the same unassigned every single week, you can make a case for it, but it's still not quite as like on the contract as the other ones are. So it can be a little bit of a harder sell from a financing perspective.
Yeah, and I'll just add on, I think what's really important when you're thinking about valuations for line haul, maybe some others do it differently, but we're always looking at the NOI, the net
Mhm.
operating income for the
Yeah.
business. And so when we're talking about kind of the comparisons, buyers typically are more interested in dedicated because it's easier to process and it's consistent mileage. But there are plenty of dedicated runs doing lower mileage less consistently than unassigned that are, much more profitable. So any of these businesses can have a different story, and it's about how consistent that mileage is, what that profitability looks like. There's plenty of low mileage dedicated runs or even low mileage unassigned runs if they're really low mileage, where they get paid a little bit differently, and the profitability of the business can actually still be really strong. So it just depends on the given business, how it's structured, how you're running those expenses that we're looking at regardless. It's just kind of a broad statement that Leah was pointing to, that when you're comparing dedicated versus unassigned, there's a certain amount of just consistency and predictability that adds value for the typical buyer. Now, I saw a quick question from Matt. What are some of the higher end sale prices we see in P&D? So, we're talking about how they've gotten higher into this 20 route range or more. Do you have any data points for some of the bigger ones that we've seen?
Oh gosh, I don't have any in front of me, but I mean 1.7 again is the average, so that's including all the high and all the low. And so, I mean, for those really big ones, I mean, we've had several businesses that are several $1 million this year. I do know that, 2, 3, $4 million.
Yeah, which is just Leah was calling it out comparing the data previously, but that's just almost unheard of in what we used to see as the typical. We would see those from time to time as almost exceptions to the
Hmm.
rule, where FedEx allowed a really strange situation, but it does reflect what Leah was mentioning, that FedEx's kind of mindset around the size contractor that they're most comfortable with has changed a lot, where the larger contractor has more contingency planning. They have more resources to handle both problems, but also growth. Growth is never cheap. And if you have more resources, it's easier to take up more opportunities as they come and as FedEx needs you to. So we're continuing to see that kind of like 20 to 30 routes is often where FedEx is wanting a lot of contractors to grow into and to get comfortable in that range. I still think FedEx is hesitant to have anybody at 50 or 60 routes. There are some contractors like that, but FedEx still doesn't want one terminal to have, a contractor that's running 90% of the volume. That's still a big risk factor for them, so they still avoid that when they can, but it is something where they have a comfort level with a little bit larger contractors. So we are seeing P&D businesses get into the multi-million dollar route range as a closer to a new normal, as opposed to just an exception that happened from time to time. Ricardo asked the question, where do I find the report? It is on our website. It went out as an email today. We will send it to attendees as well, if you haven't seen it. If I trusted myself with technology enough to put it in the chat, I would. But we can get that to you afterwards, Ricardo. And again, it is on our website for free if you're just looking for it, routeconsultant.com. Question from Eric, is FedEx okay with an owner having routes at multiple terminals? Yes. So here's the thing to think about when you're trying to kind of process where you can be, how you can manage terminals. Can you do it remotely? Remotely, yes. The thing I always tell people is you can never do one of these absentee. Never think about a FedEx business as I can run this absentee and never look at it. But there are ways to structure the business to build a manager and a driver base where you don't have to be there every day. You can be involved in the business. You can be there. Often you're talking to your manager on the phone. You may be talking to FedEx on the phone regularly. And so you don't have to physically be located at the terminal you're in. I know contractors who are operating in terminals across the country. I know contractors that are operating in 6 terminals in their states that are fairly localized, but have gotten large at a bunch of different terminals around them. There's different ways you can do it. I typically see more of kind of the countrywide spread if you're also doing line haul, because a lot of line haul contract, if you think about a typical line haul run, you may be going across the country anyways, where your drivers are driving, multiple states away. And so maybe wherever they're stopping, if you've got a dedicated run that goes from Memphis to California, maybe you pick up volume in California as well, or maybe there's a stop along the way that makes sense to add to your territory. It really depends on how you want to structure your business and how you can build the right kind of remote structure if you are planning on being remote. You always will have to interview with each terminal manager at each different terminal that you enter. Some terminal managers are really open to you being remote as long as you're available and stay on top of the business. Some are very opposed to you being remote. So it's also really important as you're looking at a terminal to make sure that you kind of know what that terminal manager's preferences are. And you also know how you plan to pitch that you can run this business remotely. Some will say you can't, and then they're comfortable with it after a couple of months. So just think about those types of things. And if you're working with us, we can help you on each individual terminal as you're thinking about interviewing and talking to that terminal manager, know what their preferences are and how to make the best case there. But in general, there's no rule that FedEx has against being at multiple terminals. You could be at every terminal in the country as long as each terminal manager approved you, and you could spread out that way. All right. I think we've talked a lot. I don't see. Oh, there Joe snuck one in as I'm talking. So this is what we were talking about for P&D, about having a larger terminal presence. So he's just kind of asking to clarify, do we see FedEx becoming more comfortable with contractors having a larger presence in a single terminal? Yes, the answer is yes. Again, FedEx is kind of more open to that 20 to 30 route range is what I'm seeing a lot of contractors end up in at a single terminal. So that's not across the country. I am seeing much more of that. Now, I will say, if you're at one of those terminals where there's only 3 contractors, less volume may go out of that terminal. So your number of routes may be smaller than that 20 to 30 range, but they are just in general being more comfortable with a larger scale percentage. So an overall percentage of the terminal, FedEx is allowing that to be larger. I haven't heard of hard scale limits in a while. It used to be a thing, as Leah was talking about, we used to have to split these businesses up all the time because FedEx was really restrictive on how what your scale percentage could be, what percentage of the terminal you could be. A lot of that, I think, was an attempt to kind of slow people down coming out of COVID, where people had grown so much that they were trying to say, okay, maybe some of you shouldn't be as large as this. You didn't really control this growth, and now we've gotten too large. But I think what FedEx has realized in the last couple of years is that there is a comfortable size for contractors to be at. question for Matt, are there courses or services for preparing for an AIM meeting? Yeah, we've got a bunch of different ways we can help there. We do have kind of full programs if you're looking at buying a route, where we'll walk you through from the very beginning, where you're making a business plan, trying to figure out the best way to get into this space, trying to build your financing, identify opportunities, all the way through the interview process, the making an offer to the seller, through interviewing with FedEx and going through all of that approval process all the way up to a close. It's called our acquisition strategy product. I think sometimes we change that name, but I'm pretty sure at this time it's
That's right.
yeah,
I'm pretty sure that's right.
yeah, it's acquisition strategy, and that is designed to kind of be a beginning to end walk through the buying process. If you're just looking for an interview, sometimes we can help there. If you reach out to us, we may be able to have a small thing that we can help with there. But typically, I find that the interview is a small piece of a much larger process where you can get help on the interview, but there's typically, five or six other things that you really need help with. So we're happy to kind of talk through where may be the best fit for that. Let me see. Okay. I think that is all the questions. Travis, I just say that so that the questions appear. It's like it's a guarantee that if I say that's all the questions, that another question comes in. So Travis is asking if we think line haul volume is going to be affected by the FedEx sale and with FedEx Freight breaking off. No, if anything, I've seen a lot of increased volume actually recently. FedEx is doing a lot of if you're familiar with the line haul network, typically growth opportunities and the runs that are at and put up for bid only usually happen in like the first few months of the year, kind of February, April timeframe. We've seen a ton of routes come up for bid over these last few months. There's been a lot of growth coming to several of the major hub networks where we're just continuing to see volume come in. I'm not expecting much impact at all from the FedEx Freight splitting off, but I do continue to see that Express. I wasn't expecting there to be a huge impact on line haul, and there's not from a negative perspective, but we are seeing volume tick up as this 2.0 model continues to evolve, where we're seeing more line haul runs come into the network. So hopefully that answers that question. All right. With that, I'm going to say that I think that's all the questions for the last time. If somebody's typing quickly, just as a quick reminder for everybody who's on here, again, this report is free. You can go get it on our website. We can send it to you afterwards. If you can't find it, just email us, info@routeconsultant.com. We'll make sure to get it to you. And a reminder too, if you're new here, if you're still trying to figure out the best things about the space, and trying to figure out the best way to get into the space, we do have a new investor workshop next week, next Friday, in our offices in Nashville. It's July 17th. It's really designed as a crash course kickoff to teach you as much as we can about the space in one day and help you make the decision to move forward or not. And that is free to attend. You just got to come down to Nashville and register on our website. And again, I knew it. As I was doing this closing, Bobby snuck in another question. So Leah, I know this is something we've seen a lot. How do we see the profitability of line haul runs get affected when they're running lots of spots?
Yeah, so spots can be very lucrative. We found on average, again, like to speak in averages here, that businesses that do spot work tend to have a 2% higher margin than businesses that don't. So it's basically a way that you can, in some cases, double utilize your trucks. You do a run during the day and spot work at other times. So it can be really lucrative. Of course, that's going to depend on your business. Sometimes spot work does not work for, a certain, schedule or structure or whatever. But again, on average, we do find that they are slightly more profitable than businesses that don't.
Yeah, and there's a few other areas that it just, besides the double utilization of the fleet, it's a good way where if you have drivers that you don't have a full run for them yet, but you hired them on early, spots can be a great way to still give them some pay, some revenue, some volume as you're waiting for a full run. It's also a great way when you've got maybe a vehicle that's too high mileage to feel comfortable sitting out on a long team run or a long solo, but you can switch it onto a low mileage spot, get some extra years and revenue out of that vehicle. So there's lots of advantages to doing it. It just depends on if you've got that opportunity at your terminal. But as Leah said, we typically see at least a 2% increase in profitability. Okay. with that, I think I'm going to go ahead. Oh, Alex raised a hand. You're physically stopping me from stopping. So, Alex, if you're typing, I'll go ahead and let you type in that question. You can put it in the Q&A or the chat if you've got it, and I'll give you a second to type before I end this. But if I don't see that soon, I'll just think that that's you, Alex, raising a hand and saying goodbye. So with that, end it. Perfect. All right, Alex and everybody, thank you so much for being here. If you have any questions that we didn't cover today, feel free to reach out to us. And we're looking forward to seeing where the rest of this year goes. And hopefully, I'll get to see some of you guys at events throughout the year. Thanks, everybody, for attending. We'll see you next time.
Thank you.